So, have you ever wondered why a government can spend billions, sometimes even trillions of dollars to stimulate a flagging economy, only to find out that it achieves absolutely nothing?
Yeah, or why your money buys an absolute feast in one country, but barely gets you like a tiny snack in another.
Right. Because we usually assume the global economy operates like this giant, predictable machine. You pull a lever over here, a gear turns over there, and you get this exact expected result.
Which is a tempting analogy, sure.
Yeah.
But you quickly find it falls apart the second borders get involved.
Exactly. But when you actually start looking at international economics, you realize half the gears are completely invisible, the levers frequently disconnect, and the machine seems to rewrite its own operating manual depending on what country you happen to be standing in.
Because domestic economics is, well, it's somewhat contained, right? You can measure the money supply, you can track employment fairly easily. But international macroeconomics introduces this incredibly volatile, fluid dimension.
And that invisible machinery is exactly what we are decoding today. Welcome to the deep dive. We are pulling from a remarkably comprehensive framework, a university-level study guide prepared by Dr. Masum Ahmed for the Department of Economics at Prague College in Assam.
It's a fantastic resource.
Right.
Our goal here is to bridge that gap between abstract academic modeling and the messy reality of the global news cycle you see every day.
Right. The mission of this deep dive is to keep it jargon-free. We want to show you how these invisible economic forces dictate literally everything, from the price of a hamburger down the street to the ultimate fate of entire nations.
Because once you map out these underlying mechanics, suddenly the bizarre behavior of global markets or the seemingly irrational decisions of central banks, it all starts making perfect, almost terrifying sense.
It really does. You stop seeing isolated financial events and start seeing the actual physics of the system.
Yeah, a currency crisis in one hemisphere or an inflation spike in another, they aren't just random shocks anymore. They are the predictable outcomes of the models we're going to explore today.
So we should probably start where most people interact with international economics for the first time, right?
Yeah.
The concept of relative value, the literal price tag of nations.
Yes, the exchange rate.
And I think anyone listening to this understands the baseline nominal exchange rate. You check the financial news, one US dollar buys roughly 83 Indian rupees. That's the sticker price.
Right, that's the ticker on the screen. But the research immediately pushes us past that surface level metric.
Hmm.
It focuses heavily on the real exchange rate and subsequently the effective exchange rate.
Wait, let's break that down. If the nominal rate is just the sticker price, the real rate is the actual translation of purchasing power, right?
Exactly. It adjusts that nominal sticker price for the relative inflation and the actual price levels between the two countries. It's the metric that tells you how internationally competitive a country's goods actually are.
That distinction feels really vital.
Oh, it's huge. Because think about it. If your nominal currency depreciates by 10% against the dollar, you might think, hey, my exports just became 10% cheaper and more competitive globally.
Right, a sudden advantage.
But if your domestic inflation is simultaneously running 10% higher than in the US, well, your real exchange rate hasn't changed at all. Your exports cost exactly the same in real terms to a foreign buyer.
Oh, wow. So the nominal drop is basically just an illusion masking the inflation.
Precisely. And as you mentioned, we have to aggregate this because no nation trades bilaterally with just one single partner. The effective exchange rate weighs your currency against all basket of currencies from your major trading partners.
And it weights them proportionate to how much trade you actually do with them, right?
Yeah, it gives policymakers this single holistic dashboard gauge of their global competitiveness.
Okay, so that brings us to the theoretical anchor of all of this. Purchasing power parity, or PTP.
The big one.
Yeah, the entire concept of PPP rests on what economists call the law of one price. The premise is fascinating just in its simplicity. It argues that in a frictionless, perfectly competitive global market, identical goods sold in different countries should eventually have the exact same price when you convert them to a common currency.
And the mechanism enforcing that theoretical law is arbitrage. It's the financial equivalent of water finding its level.
Arbitrage. Let's make sure we define that clearly for everyone,
Sure. So if we pretend for a moment that shipping is free and instantaneous,
which it obviously isn't, but for the sake of the model.
right, for the model, and we look at a highly standardized commodity like gold, if gold is trading significantly cheaper in London than it is in New York, the market will not allow that discrepancy to persist.
Because traders will jump on it immediately.
Exactly. Traders, or more accurately today, high-frequency algorithms, will instantly buy the cheaper gold in London and sell it into the more expensive market in New York.
And that buying pressure in London pushes the London price up, while the massive supply being dumped in New York pushes the New York price down.
Right, until they meet right in the middle. The arbitrageurs profit off the spread until the spread vanishes completely.
It's like magic, the magic of localized self-interest forcing global price equalization.
Yeah, and absolute purchasing power parity simply scales that logic up. From a single commodity to the entire macroeconomic price level of a nation, it theorizes that exchange rates should essentially act as the great equalizer between the overall price levels of two different countries.
Okay, I have to challenge this premise, though, because the source material points to the most famous, tangible test of this theory, The Economist magazine's Big Mac Index.
Ah, yes. The Big Mac Index.
They use a McDonald's Big Mac as the proxy for the identical good, right?
Yeah.
Because it's standardized, the ingredients are uniform, and it's sold almost everywhere on Earth.
It's a very clear, real-world data set.
So, looking at the data provided, a Big Mac costs about $5.69 in the United States. In India, a comparable localized version costs 210 rupees.
Okay, so let's run the PPP math on that.
Right. If the law of one price holds absolute reality, those burgers should cost the exact same. So to find the implied exchange rate where 210 rupees has the exact same purchasing power as $5.69, you divide 210 by 5.69.
And what does that give us?
It gives you an implied exchange rate of about 36.9 rupees to the dollar.
That is what the exchange rate theoretically should be if the burger market was in perfect arbitrage equilibrium.
But the actual nominal exchange market rate is sitting at around 83 rupees to the dollar. I mean, the gap is enormous. According to this index, the rupee is apparently undervalued by something like 55%.
There's a massive discrepancy, yes.
So if arbitrage is such an ironclad force of financial physics, why isn't the market correcting this? Like, why aren't global traders buying millions of 210 rupee Big Macs in Mumbai, flying them to Chicago and selling them for nearly $6 a pop to lock in a massive risk-free profit?
I love that image.
Doesn't it kind of prove that PPP is broken? The discrepancy is so large it almost feels like it disproves the entire utility of absolute PPP.
Well, no, the Big Mac example doesn't disprove PPP at all. Rather, it beautifully exposes the friction of reality that the pure theory just assumes away.
Friction like what?
Well, to answer your hypothetical about the arbitrageurs flying burgers around the world, the first obvious barrier is transportation cost and spoilage. A burger is highly perishable.
True, you can't exactly put it on a container ship for 4 weeks.
Right. And the second barrier involves trade tariffs, taxes, and import quotas that distort cross-border pricing. But honestly, those are actually the minor factors here.
Gee, those are the minor factors? Then what's the primary reason?
The primary structural reason the law of one price fails so dramatically in the real world is the presence of non-tradable goods.
Non-tradables. Okay, so elements of the economy that are geographically locked.
Exactly. Consider the composition of a Big Mac. You can trade the agricultural commodities, the beef, the wheat for the bun, the sesame seeds. Those can be packed in a shipping container and arbitraged globally.
Sure, they have a global market price.
But a hamburger is not just a collection of physical ingredients. It is the delivered service.
Yeah.
You cannot put the prime commercial real estate that the restaurant sits on into a suitcase and trade it in New York. You cannot export the local electricity used to run the fryers. And most critically, you cannot arbitrage the labor of the person standing at the grill cooking the burger.
Oh, wow. Those are non-tradable, highly localized costs, deeply embedded in the final retail price of the good.
Yes. So when we compare the price of a burger in two different countries, we aren't actually comparing identical goods. We are comparing identically sourced ingredients fused with wildly different local service and labor costs.
That makes so much sense. We're comparing the rent in Chicago to the rent in Mumbai, basically.
Which leads us directly to one of the most elegant concepts in the research, the Balassa-Samuelson effect.
The Balassa-Samuelson effect.
Yes. Bala Balassa and Paul Samuelson independently modeled this in the mid-1960s to explain a persistent anomaly. They wanted to know why wealthy developed nations systematically exhibit higher overall price levels than developing nations.
Which is the exact phenomenon that persistently makes developing nations' currencies look undervalued. So, if I'm tracking the logic here, the Balassa-Samuelson effect essentially acts as a penalty or maybe a distortion on a developing nation's apparent economic size. And it all comes down to the productivity gap in the tradable sectors.
Right, that distortion is the perfect way to conceptualize it. Let's trace the actual mechanics. Take a highly developed economy, say the United States. It possesses a hyperproductive tradable sector. We are talking about advanced software engineering, high-end pharmaceuticals, aerospace manufacturing.
Also, your type of value stuff.
Right, because those industries are incredibly productive and they export to a massive global market, they generate staggering revenues.
Hmm.
Consequently, they can afford to pay exceedingly high wages to their workers.
Like the software engineer in Silicon Valley who makes $300,000 a year because their code is utilized by billions of people globally.
Exactly. But here is the critical pivot in the model. The domestic labor market is interconnected. The tech sector doesn't exist in a vacuum.
So those high wages bleed into everything else.
Yes. Because the tradable sector pays such astronomical wages, it exerts massive upward pressure on wages across the entire domestic economy through a process called wage equalization.
Wait, how does that work for, like, normal jobs?
Well, if you want to hire a barber, a barista, or someone to manage a fast food restaurant in Silicon Valley, you are competing for labor in an environment awash with tech money. You have to pay those service workers a significantly higher wage than you would in a developing country.
Just to incentivize them to take the job and to allow them to survive the localized cost of living.
Right. But here's the fascinating part. The productivity of the barber hasn't changed at all.
Right, a haircut takes 20 minutes whether you are in San Francisco or Mumbai. The barber in the rich country isn't utilizing, like, advanced robotics to cut hair faster.
Exactly. The physical productivity of the non-tradable service is identical in both countries. Yet, because of the Blaser-Samuelson effect, the price of that haircut and the price of the labor embedded in cooking our hypothetical Big Mac skyrockets in the rich country just to keep pace with the tradable sector.
Oh, I see. And the developing country, which might not have a massive hyper-productive software or aerospace sector driving up aggregate wages, maintains a much lower cost of living for those non-tradables.
Yes. Therefore, the poorer country's currency appears undervalued strictly because its local non-tradable services are cheaper. It is not a failure of the exchange rate market. It is an accurate reflection of local wage dynamics.
It fundamentally changes how we should interpret macroeconomic scale. Like, the data in Dr. Ahmed's guide regarding India's GDP highlights it beautifully.
The India data is a perfect illustration.
Yeah, if you measure India's total economic output, its GDP, using the standard nominal market exchange rate, the economy is valued at roughly $3.7 trillion, which places it as the fifth largest economy in the world.
It's a massive number, sure, but it doesn't quite capture the internal reality.
Not at all. If you adjust that GDP for purchasing power parity, if you mathematically correct for the fact that a haircut, a doctor's visit, or a local meal costs a fraction of what it does in the U.S. because of the Blaser-Samuelson effect, India's peepingly adjusted GDP explodes.
To what?
To a staggering $13.1 trillion.
Wow. That adjustment shifts India from the fifth largest economy to the third largest economy on the planet, placing it right behind the United States and China.
Because the sheer volume of goods and services being consumed internally is far greater than the nominal dollar conversion suggests.
And it's even more dramatic on per-person basis, right?
Yeah, completely. At the market exchange rate, India's per capita income sits around $2,600. But adjusted for PPP, the average purchasing power is closer to $9,200.
That is a huge difference for an individual.
If you are trying to understand the actual living standards, the caloric intake, the housing realities of a population, the nominal exchange rate is almost entirely useless. You have to view it through the lens of PPP.
PPP provides an unparalleled compass for understanding long-term structural economic realities. It tells us where exchange rates should theoretically drift over a multi-decade horizon based on inflation differentials. It really is the gravitational center.
But of course, there's a but coming.
Always. However, as any corporate treasurer or forex trader knows, you cannot run a business or a national economy based solely on decades-long gravitational trends.
Right, because currencies do not glide smoothly along a PPP trajectory. They are wildly volatile. They spike, they crash, they trend aggressively away from their PPP equilibrium for years at a time.
Exactly. To understand that short to medium-term volatility, we have to transition from the theory of price levels to the reality of actual money movement. We have to open up the nation's ledger.
The balance of payments, or the BOP?
The BOP.
The research defines this as the systematic, comprehensive record of all economic transactions between the residents of one country and the rest of the world over a specific period. I always look at the BOP the same way I look at a personal household budget, just scaled up to a sovereign level.
That household analogy is remarkably robust, actually, if we apply it strictly to the architecture of the accounts, because the balance of payments is structurally divided into three primary ledgers.
Okay, let's go through them. The first one is the one we hear about all the time in the news, right? The current account.
The current account. This represents the daily operational hustle of a nation. It records the trade in physical goods, exporting automobiles, importing crude oil or
The
microchips.
tangible stuff on boats.
Right. But it also includes the trade in services, which is increasingly dominant in the modern era. Things like software licensing, financial services, or international tourism.
Okay, so goods and services. What else is in there?
Beyond trade, the current account captures primary income. This tracks the cross-border flow of wages and investment returns. So if a U.S. citizen owns stock in a Japanese company, the dividends paid back to the U.S. are recorded here.
Makes sense.
And finally, it captures secondary income, which consists of unilateral transfers where nothing is received in return. Things like foreign aid or, crucially, remittances sent home by migrant workers.
So to summarize, the current account is essentially the net sum of what the country is earning from its global interactions minus what it is spending to sustain its consumption. If you are importing more physical goods and services than you are exporting, you are running a current account deficit.
Spot on. Now, the second ledger is the capital account. For most major economies, this is a relatively negligible account.
Oh, really? Why is that?
It handles non-produced, non-financial assets. Think of the transfer of land rights for an embassy or the outright forgiveness of sovereign debt. It doesn't move the needle much day to day.
Okay, so if the capital account is tiny, what balances out the current account?
The true counterbalance is the third ledger, the financial account. This is the realm of asset ownership.
Asset ownership. Give me some examples.
It tracks foreign direct investment, or FDI, where a foreign entity builds a factory or buys a controlling stake in a domestic company. It also tracks portfolio investment, the highly liquid, fast-moving capital buying up domestic stocks and government bonds.
And central bank reserves, too.
Yes, it includes the transactions involving the central bank's own foreign exchange reserve assets.
Okay, here is the absolute foundational rule of international accounting that the research establishes. The balance of payments must mathematically balance to zero.
Always.
The sum of the current account, the capital account, and the financial account is always zero. It is a strict double-entry bookkeeping identity.
It literally cannot be violated. Every single international transaction has two sides.
Going back to that household budget analogy, if I'm running a personal current account deficit, meaning I'm spending more money on groceries, dining out, and buying electronics than my salary brings in, I have a mathematical hole in my finances.
Big hole.
Right. And because reality demands that my personal ledger balances, I have to finance that excess consumption. I really only have two choices. I can borrow money, perhaps putting the excess spending on a credit card or taking out a bank loan.
Which is taking on debt.
Exactly.
Yeah.
Or I can sell off my existing assets, maybe selling my car or dipping into my stock portfolio. On a macroeconomic scale, a nation running a current account deficit is doing the exact same thing. They must finance that deficit by either borrowing money from foreigners or selling domestic assets to foreigners. Both of those actions create a massive influx of capital, which registers as a surplus in the financial account.
That is the inescapable reality of a trade deficit. You are trading the ownership of your future assets to finance your present consumption.
Which sounds kind of terrifying when you put it like that.
It does. The guide provides a masterful breakdown of this exact dynamic using India's macroeconomic data from the 2022-23 fiscal year. It's a perfect case study of how these different accounts interact to stabilize a potentially volatile situation.
Let's dissect those numbers because they paint a really complex picture of a modern developing economy. So, looking at the data, India ran a staggering deficit in merchandise goods, about $265 billion.
That is a massive outflow of wealth.
Yeah, but that isn't because they aren't manufacturing anything. It's driven largely by inelastic structural needs. India is a rapidly industrializing nation with a massive population, and they import heavy, incredibly expensive commodities. They import the vast majority of their crude oil, and they are one of the world's largest importers of gold.
And that $265 billion hole could be economically catastrophic for a developing nation if viewed in isolation.
Absolutely.
But the current account is not just physical goods. India possesses a globally dominant services sector. While they were bleeding capital to import oil, They were simultaneously running a colossal surplus in IT, software, and business services.
And that brought in roughly $143 billion, right?
Yes. Furthermore, the demographic reality of India plays a crucial role in its macroeconomic stability. Millions of Indian citizens work overseas, from software engineers in the United States to construction and service workers in the Gulf states.
And they send money back.
The money they send back home, remittances, acts as a massive, stabilizing financial lifeline. In that year, India received the highest remittance inflows in the world, totaling approximately $125 billion.
Wow. So you take this terrifying $265 billion trade deficit driven by oil and gold. You fill that hole with $143 billion in high-margin tech services. You fill it further with $125 billion in direct cash remittances from citizens abroad.
And when the dust settles on the current account ledger, that initial $265 billion catastrophe has been whittled down to a highly manageable current account deficit of about $67 billion.
It's an incredible balancing act. And because the BOP must sum to zero, that $67 billion deficit is seamlessly financed by a corresponding surplus in the financial account.
Exactly. The global market looks at India's growth trajectory and eagerly deploys capital. Massive inflows of foreign direct investment into Indian infrastructure and manufacturing, coupled with portfolio investments into the Indian stock market, provide the exact influx of foreign capital required to finance the remaining deficit.
The ledger balances perfectly.
It balances perfectly.
It's an incredible high-wire act of global finance. But, it begs a rather obvious policy question. Let's say a nation doesn't have a booming IT sector or a massive diaspora sending home billions of dollars. They're just bleeding cash through a massive trade deficit.
A tough situation.
The intuitive, politically popular solution is almost always devalue the currency, right? If a government intentionally weakens its currency, its exports suddenly look incredibly cheap to foreign buyers, so export volume should theoretically explode.
That's the hope.
Simultaneously, foreign imports become painfully expensive for domestic citizens, so they should stop buying imported flat-screen TVs and imported cars. The trade deficit should theoretically vanish overnight. Why doesn't it work that cleanly?
Because economic agents do not react instantaneously, and they do not react proportionally. The belief that a cheaper currency automatically fixes a trade deficit ignores a foundational economic metric, price elasticity.
Price elasticity.
The research introduces the Marshall-Lerner condition to explain this. This condition states that a currency devaluation will only improve the trade balance if the combined price elasticities of demand for a nation's exports and imports are strictly greater than 1.
We really need to unpack price elasticity deeply because it seems like it's the linchpin of whether a nation's trade policy succeeds or totally self-destructs.
It absolutely is.
Elasticity essentially measures behavioral stubbornness, right? How intensely do consumers react to a change in price?
Exactly. Let's apply it to imports first. If your currency depreciates by 20%, everything you import just became 20% more expensive in domestic terms.
Just overnight.
Overnight. Now, if your citizens are highly sensitive to that price change, say the imports are luxury items, foreign vacations, or electronics that have perfectly fine domestic substitutes, they will aggressively cut their consumption.
They just won't buy it.
Right, that demand is elastic. It stretches and snaps back quickly when the price moves. But what if the import is a structural necessity? What if it is crude oil required to keep the electrical grid running, or specialized pharmaceutical ingredients, or advanced machinery that simply isn't manufactured domestically?
In that scenario, the demand is inelastic. The price goes up 20%, but the factory still needs the machinery, the hospitals still need the medicine, and the trucks definitely still need diesel.
Precisely. The citizens grit their teeth and pay the higher price because they have no viable alternative. They might reduce consumption by 2% or 3%, but they are absorbing the vast majority of that 20% price hike.
And that is where the trap snaps shut. If your demand for imports is heavily inelastic, and the foreign demand for your specialized exports is also inelastic, meaning dropping your export prices doesn't trigger a massive wave of new foreign orders, the combined elasticity falls below 1.
The Marshall-Lerner condition fails.
And when a nation in that scenario devalues its currency, It doesn't fix its trade deficit. It actually makes the deficit significantly worse
Mhm.
because they are now paying vastly more domestic currency to acquire the exact same vital volume of imports without experiencing any compensatory boom in export revenue.
It's a brutal punishment.
I love the visual analogy used to describe the timeline of this process. When the Marshall-Lerner condition does eventually hold true, it's called the J-curve effect.
The J-curve is such a helpful visualization.
It really is. Imagine a nation's economy is a colossal, multi-100,000-ton cargo ship drifting toward an iceberg, which represents an unsustainable trade deficit. The captain, representing the central bank, violently spins the ship's wheel to alter course. That's the currency devaluation.
Okay, I see it.
But the ship is so massive and
Yeah.
its forward momentum is so overwhelming that even with the rudder fully turned, the ship continues to drift sideways in the wrong direction for miles.
And the J-curve traces that exact agonizing trajectory on a graph. The horizontal axis is time, and the vertical axis is the trade balance. When the devaluation hits, the line doesn't go up toward surplus. It immediately hooks violently downward, deepening the deficit.
Why does it drop first?
This is the mechanical reality of global supply chains and sticky contracts. When a currency drops, the price of imported goods spikes instantly. But businesses cannot instantly rewrite their logistics. A retailer who imports electronics has contracts signed 6 months ago, priced in dollars. The cargo is literally on the water. They have to pay for those goods at the new, terrible exchange rate.
They're locked in.
And on the export side, your goods are suddenly cheaper for foreigners. But you don't instantly have twice as many factories to meet potential new demand. You have to hire workers, source raw materials, and negotiate new contracts. The foreign buyers also need time to realize your goods are cheaper and switch their suppliers from a different country over to you.
So that psychological and logistical inertia takes months, sometimes over a year, to overcome.
Exactly. During that lag, the nation is simply suffering the mathematical punishment of higher import prices without the volumetric reward of higher exports.
Yeah.
That is the downward hook of the J.
And eventually it turns around.
Eventually, yes. The new reality sets in. Consumers substitute expensive imports for cheaper domestic alternatives. Foreign buyers ramp up their orders of your newly competitive exports. The trade balance finally catches the new current and shoots upward, tracing the long stem of the J.
The crucial takeaway for policymakers seems to be the necessity of nerve. Like if a government panics during the dark days of the downward hook and reverses the devaluation policy because the deficit is temporarily widening, they abort the entire structural adjustment before it has a chance to succeed.
It requires immense political courage to survive the bottom of the J-curve.
Now, this entire framework views the trade deficit as a mechanical issue of pricing and logistics. But the source material introduces a profound philosophical pivot that completely alters how you view international economics.
The absorption approach.
Yes. Developed by Sidney Alexander in 1952 in the aftermath of World War II reconstruction, he distilled the entire complexity of the balance of payments down to a brutally simple macroeconomic identity. CA equals Y minus A. The current account equals national income minus domestic absorption.
Alexander's genius was shifting the focus entirely away from the borders and looking purely at domestic behavior.
Define absorption for us.
Absorption is just an aggregate term for total domestic spending. It's the sum of household consumption, corporate investment, and government expenditure. If a nation is running a current account deficit, Alexander argued, it is not necessarily because their exports are uncompetitive or their exchange rate is misaligned.
Then what is it?
It's fundamentally because the nation is absorbing, meaning consuming, and investing more resources than it is actually producing.
It transforms a trade issue into a savings issue. A trade deficit is a literal manifestation of a macroeconomic savings shortfall. If A, absorption is greater than Y, income, the equation is negative. You are literally living beyond your structural means.
Exactly. And this implies that tinkering with the exchange rate is merely treating a symptom. A devaluation will only cure a trade deficit if it magically increases total national income, which is nearly impossible if the economy is already at full employment or if it violently forces the domestic population to absorb less.
But it has to make them poorer.
Yes, it forces them to consume fewer goods, thereby freeing up resources to be exported. It's a bitter pill that politicians rarely want to explain to their electorate.
And if Alexander shifted the focus to savings, the monetary approach to the balance of payments, or MAP, developed by Harry Johnson and Robert Mundell in the 1970s, shifted the focus entirely to credit.
The monetary approach views the balance of payments not through the lens of trade or savings, but strictly as a monetary phenomenon. The logic is so elegant.
But walk us through it.
Imagine a central bank, perhaps facing political pressure to stimulate growth or fund government debt, rapidly expands domestic credit. They print a massive amount of new money.
Okay, the printing presses are running.
The citizens and businesses suddenly find themselves holding excess liquidity. What does a rational agent do with excess cash? They spend it or they invest it.
But in an open, globalized economy, that spending isn't confined to domestic borders.
Precisely. A significant portion of that newly minted money will be used to purchase imported goods or to buy foreign financial assets. The excess money supply physically leaks out of the domestic economy.
And that leakage is the balance of payments deficit.
Yes. The central bank watches its foreign exchange reserves drain away because citizens are continuously trading in their newly printed domestic currency to acquire the foreign currency needed to buy those imports.
So what's the policy implication there?
It's draconian but mathematically sound. If a country wants to stop hemorrhaging foreign reserves and cure a BOP deficit, they cannot just play games with tariffs or exchange rates. They must permanently shut off the spigot of excess domestic credit creation.
So, synthesizing where we are on this journey so far, purchasing power parity shows us the long-term gravitational pull of inflation on currencies. The balance of payments shows us the medium-term flows of trade, savings, and credit adjusting across borders.
Right.
But this brings us to the most urgent question for anyone actually running a country. How do policymakers steer the economy right now, today? What actually happens when a government decides to slash taxes or the central bank cuts interest rates in a world where money can cross oceans in a millisecond?
You are asking for the grand unified theory of open economy policymaking. And that brings us to the absolute crown jewel of the research of the Mundell-Fleming model.
Developed by Robert Mundell and Marcus Fleming in the early 1960s, they took the foundational ISLM model, which was designed by John Hicks to explain the closed, isolated economies of the Great Depression era, and they just blew the doors off.
They did. They adapted the model for a world that was rapidly globalizing, integrating international trade, and, crucially, cross-border capital flows.
To grasp the staggering implications of the Mundell-Fleming model, we have to accept its core radical assumption, right? Perfect capital mobility.
Yes, perfect capital mobility. We are leaving behind the world where moving money required shipping physical gold bars on boats. We are entering a world where billions of dollars of institutional investment capital, pension funds, hedge funds, sovereign wealth funds can instantly cross borders with a keystroke.
Relentlessly hunting for the highest possible yield. Capital has no loyalty. It only cares about the return on investment.
Because this massive ocean of global capital flows so freely and so aggressively, a small or medium-sized open economy fundamentally loses control of its own interest rate.
Wait, really? How does it lose control?
Consider the mechanics. If the prevailing global interest rate is 5% and a domestic central bank decides to stimulate its economy by dropping its domestic rate down to 3%, it triggers an instantaneous financial earthquake.
Because of the yield difference.
Yes. Global investors look at that 3% yield, realize they are losing money compared to the global baseline, and instantly liquidate their domestic holdings. Massive capital flight ensues.
And that aggressive outflow drains liquidity from the domestic system.
It tightens credit conditions until the domestic interest rate is violently forced right back up to the 5% global baseline. The domestic interest rate is essentially chained to the world interest rate. In the model's terminology, R is inextricably locked to R star.
The central bank is practically a hostage to global capital markets. So how does a government possibly manage its economy under these constraints?
The model proves that a government's ability to influence its own economy is entirely dictated by one single architectural choice, whether the nation utilizes a fixed exchange rate or a flexible exchange rate.
Okay, let's walk through the exact mechanical chain reactions here step by step. Starting with scenario A, a fixed exchange rate regime. This means the central bank has publicly pegged its currency to another, say the US dollar, and legally promised to defend that exact price by buying or selling foreign reserves.
Okay, scenario A, fixed rate. Let's test fiscal policy.
Let's do it. The government decides the economy is sluggish, so they authorize a massive multi-trillion-dollar infrastructure bill to build high-speed rail networks across the entire country. Government spending dramatically increases.
Okay, we trace the shockwaves. The massive government spending directly stimulates aggregate demand. Construction companies hire workers, steel mills ramp up production, national income rises.
Makes sense so far.
As the domestic economy heats up, the transactional demand for money increases. Businesses need more cash to meet payroll, consumers need more cash to spend. This rising demand for money puts slight upward pressure on the domestic interest rate, pushing it incrementally above that 5% global baseline.
Ah, and because we have perfect capital mobility, the global ocean of capital instantly detects that tiny yield advantage. Trillions of dollars flood into the country to capture that premium return.
Exactly. This creates an overwhelming surge in demand for the domestic currency. Foreign investors have to buy the local currency to invest in these higher-yielding local bonds. The sheer buying pressure wants to force the currency to appreciate rapidly.
But remember the architectural constraint. The country operates on a fixed exchange rate. The central bank cannot legally allow the currency to strengthen. They must defend the peg.
Right. And how do they defend it against a tsunami of foreign capital?
They intervene aggressively in the foreign exchange market. The central bank creates new domestic currency out of thin air and uses it to purchase all that incoming foreign capital. They are essentially absorbing the shock.
But by printing all this new money to buy foreign reserves, they are massively expanding the domestic money supply.
Oh, I see the loop. They are forced to expand the money supply to protect the exchange rate, but that expanding money supply floods the domestic banking system with liquidity.
And that flood of liquidity automatically pushes the domestic interest rate right back down to the 5% global level. This is the crucial twist. In a closed economy, massive government borrowing drives up interest rates, which crushes private corporate investment, a phenomenon known as crowding out. But here, the perfect capital mobility forces an automatic monetary expansion that entirely prevents interest rates from rising. There is absolutely zero crowding out.
The result is spectacular. You get the pure, unadulterated economic boom from the initial infrastructure spending, mathematically amplified by an automatic, forced expansion of the money supply. Under a fixed exchange rate, fiscal policy is incredibly, almost dangerously effective.
It is the ultimate economic stimulant.
Oh.
But let's look at the dark side of the fixed rate. Let's test monetary policy now.
Okay, monetary policy. The government isn't spending money. Instead, the central bank independently decides to stimulate the economy by aggressively printing money and buying domestic bonds to lower interest rates.
The money supply increases, so the domestic interest rate drops below the global 5% baseline.
And the global capital markets immediately punish them, right? Capital flees the country, seeking the higher 5% yield abroad. This massive sell-off means investors are dumping the domestic currency, creating intense downward pressure. The currency wants to depreciate rapidly.
But again, they're committed to a fixed exchange rate. The central bank must prevent the depreciation.
So the central bank has to reverse its own actions. To prop up the currency, they have to burn through their precious foreign exchange reserves, buying back their own domestic currency from the open market.
And when a central bank buys back its own currency, it removes that money from circulation. The money supply shrinks rapidly until it returns to the exact level it was before they started the stimulus.
The entire policy initiative is completely mechanically neutralized.
Under a fixed exchange rate with perfect capital mobility, independent monetary policy is completely useless. The central bank defeats itself merely to maintain the currency peg.
That paints a really grim picture for central bankers. But what if we change the rules of the game? Let's move to scenario B, a flexible exchange rate. The central bank completely steps away from the foreign exchange market. They let the currency float. Its value is determined purely by the chaotic supply and demand of global traders. No intervention.
A completely different universe. Let's run the fiscal policy test again in this flexible environment.
Okay, the government authorizes the exact same multi-trillion-dollar high-speed rail project. Government spending surges, national income rises, and the rising demand for money pushes domestic interest rates slightly above the global baseline.
The global capital detects the higher yield. Trillions of dollars swarm into the country, creating massive demand for the domestic currency.
But this time, the central bank sits on its hands. There is no peg to defend.
So the massive buying pressure causes the domestic currency to violently appreciate. It becomes incredibly strong relative to the rest of the world.
A strong currency sounds like a sign of national strength, but from a trade perspective, it's devastating.
It is lethal to the tradable sector. Because the currency is so strong, the nation's manufactured exports cars, machinery, agricultural goods become painfully expensive for foreign buyers. Export orders collapse.
While simultaneously, foreign imports look like an absolute bargain to domestic consumers. Why buy a locally made television when the imported one is functionally 30% cheaper due to the exchange rate? Imports surge.
So net exports absolutely plummet into the red.
And here is the brutal mathematical reality of the Mundell-Fleming model. The economic contraction caused by the collapse in the export sector perfectly, dollar for dollar, cancels out the economic expansion generated by the government's infrastructure spending.
It cancels it out completely.
Wait, if I'm synthesizing this correctly, under a flexible exchange rate, if a politician promises to build $1 trillion worth of infrastructure to fundamentally grow the size of the economy, the actual net change to total aggregate output might be exactly zero.
It is a shocking realization, but yes. The model calls this exchange rate crowding out. The fiscal stimulus doesn't actually raise overall national income. It merely alters the composition of the economy.
How so?
The nation successfully builds its new high-speed rail network, sure, but it inadvertently decimates its manufacturing and export sectors in the process. Under a flexible regime, fiscal policy is completely ineffective at sustainably altering aggregate output.
That entirely upends the conventional political narrative surrounding government spending. It's almost depressing. So what actually works in a flexible system?
Monetary policy. Let's run the final test. The central bank prints money, pushing the domestic interest rate below the global baseline. Capital immediately flees the country, dumping the domestic currency.
And because it's a flexible system, the central bank just allows the currency to collapse. It depreciates aggressively.
Which acts as a massive adrenaline shot to the trade sector. Your exports are suddenly the cheapest, most competitive goods on the global market. Foreign buyers clear out your inventories. Net exports boom, driving a massive increase in national output and employment.
Oh, wow. So under a flexible exchange rate, monetary policy is highly effective.
Yes, but notice the transmission mechanism. The central bank didn't stimulate the economy by making it easier for domestic businesses to borrow money. The entire stimulus bypassed the domestic credit channel and functioned almost exclusively by manipulating the exchange rate to capture foreign demand.
The implications here are staggering. Whether a government policy works or whether it actively sabotages the nation isn't about the moral virtue or the political popularity of the policy itself. It is entirely ruthlessly dictated by the architectural constraints of the country's openness and its exchange rate regime.
Which leads us directly to the seminal macroeconomic revelation of the 20th century. Robert Mundell looked at these exact constraints and synthesized what is essentially a fundamental law of physics for global finance.
The impossible trinity, also known as the trilemma.
The trilemma.
The research builds toward this as the ultimate constraint. It states that a sovereign nation cannot simultaneously achieve three specific policy goals. Number one, a fixed exchange rate, which provides stability for international trade and predictability for importers. Number two, free capital mobility, which allows a nation to attract vital foreign investment and integrate into global financial markets. And number three, independent monetary policy, which allows a central bank to set its own interest rates to manage domestic inflation and fight recessions.
It is an absolute, mathematically binding constraint. A nation can successfully pursue any two of those goals, but it can never, under any circumstances, possess all three simultaneously.
Attempting to force all three inevitably triggers a catastrophic financial crisis, usually culminating in a speculative attack that destroys the currency peg. I conceptualize the trilemma like a cruel, uncompromising restaurant menu. You sit down, and the macroeconomic universe hands you a menu with three incredible mouth-watering options. You desperately want the frictionless trade stability of a fixed currency. You want the booming technological investment that comes from free-flowing global capital. And you demand the sovereign power to control your own money supply to protect your citizens from economic shocks.
You want it all.
But the universe looks at you and says, you only have enough currency to buy two. Make your choice and prepare to suffer the loss of the third.
That is precisely the agonizing calculation every modern government must make. And looking at how the world's major economies have navigated this menu reveals the architecture of the modern global system. Take the Eurozone, for example.
Okay, let's look at Europe.
The architects of the European Union desperately wanted absolute exchange rate stability across Europe to facilitate a unified market. They went to the extreme of creating a brand new fiat currency, the euro, to lock the exchange rate permanently. They also demanded perfect, frictionless, free capital mobility across the continent.
So they chose options 1 and 2 on the menu. What did they sacrifice?
They sacrificed their economic sovereignty. They surrendered independent monetary policy. A sovereign nation like Italy or Spain or Greece no longer possesses the ability to print its own money or lower its own interest rates if it suffers a localized recession or a debt crisis.
They handed that awesome power over to an unelected European central bank sitting in Frankfurt.
And the pain of that sacrifice became acutely visible during the European debt crisis, when nations were trapped in severe recessions but lacked the monetary tools to stimulate their domestic economies.
Okay, contrast that with the United States.
The United States chose a different path. Wall Street and the U.S. corporate sector demand perfect as a melon. Free capital mobility, trillions of dollars flow in and out of American asset markets daily. And the political system demands absolute independent monetary policy, empowering the Federal Reserve to aggressively raise or lower interest rates strictly based on domestic inflation and employment targets, largely ignoring the rest of the world.
They chose options 2 and 3, so the sacrifice is the fixed exchange rate. The US dollar floats completely freely, subject to wild, unpredictable swings based on the whims of global forex traders and shifting interest rate differentials.
Exactly. And finally, let's look at a massive developing economy like India to see the third combination.
What's India's choice?
India absolutely requires independent monetary policy, so the Reserve Bank of India can manage growth and inflation for its billion-plus citizens. And because they import vital, price-sensitive commodities like oil, they desire a managed or fixed exchange rate to prevent extreme currency volatility from importing massive inflation into the domestic economy.
So they want options 1 and 3, so they must sacrifice free capital mobility.
And they do. India maintains a complex, highly regulated architecture of capital controls. They utilize frameworks like the Foreign Exchange Management Act and the liberalized remittance scheme to aggressively monitor, restrict, and tax the flow of capital moving across their borders.
An Indian citizen cannot simply wire millions of dollars to a Swiss bank account with a click of a button. There are strict annual limits and regulatory hurdles.
By throwing sand in the gears of capital mobility, the RBI retains the power to manage its exchange rate while simultaneously setting its own domestic interest rates.
Pick 2. It is an inescapable law. If you try to cheat the system, the market will break you.
And this brings us to the ultimate intellectual challenge of the research, the grand synthesis.
The grand synthesis.
We have covered an immense amount of theoretical ground today. We started with the Balassa-Samuelson effect and purchasing power parity, analyzing multi-decade inflation trends. We moved to the balance of payments, looking at annual trade and capital flows, and we just dissected Mundell-Fleming, mapping instantaneous millisecond reactions to central bank policy.
How do we pull these seemingly disparate, contradictory models into a single, unified theory of how the world actually works? Because right now, it feels like we have 3 different compasses pointing in 3 different directions.
The breakthrough is realizing that these models are not competing to describe the same phenomenon. They are simply operating on entirely different timelines. The grand synthesis is a master theory of time.
Walk us through the chronological layers.
In the short run, which we can define as days, weeks, or perhaps a few months, the Mundell-Fleming model reigns supreme. In this immediate time frame, the prices of physical goods are essentially frozen, but financial capital flows instantaneously, violently chasing interest rate differentials across borders.
That explains the immediate chaotic shocks to the system when a central bank unexpectedly pivots its policy.
Yes. Moving to the medium run, spanning several months to a few years, the balance of payments and the fundamental forces of supply and demand take over. This is the timeline of the J-curve. It takes time for logistics to adjust, for trade flows to shift, and for the gradual pressures of export and import imbalances to slowly dictate the supply and demand for a currency.
And the long run.
Finally, in the long run, stretching across decades, purchasing power parity asserts itself as the ultimate macroeconomic gravity. Regardless of short-term interest rate panics or medium-term trade deficits, the exchange rate will inevitably be pulled toward the equilibrium required to equalize purchasing power based on the divergent inflation rates between the two nations.
Short-run financial shocks, medium-run logistical trade flows, long-run inflationary gravity, it forms a remarkably coherent timeline. But the transition between these phases must be chaotic. How does an economy actually navigate from the hyper-volatile short-run shock to that serene, long-run PPP equilibrium without tearing itself apart?
The transition is brutal. And the genius who finally mapped that chaotic bridge was Rudi Dornbusch with his overshooting model in 1976. Dornbusch identified a profound asymmetry in the global economy. Financial markets adjust at the speed of light, but goods markets, the physical prices of things, are sluggish and sticky.
It's the difference between a currency trader in London shorting the yen with an algorithm in 3 milliseconds versus a local restaurant owner in Tokyo deciding they finally need to reprint their menus to reflect the higher cost of imported beef, which might take 6 months.
That asymmetry is everything. Because of that severe mismatch in reaction speeds, if a central bank suddenly injects massive liquidity into the system by increasing the money supply, the financial markets panic instantly. Capital flees and the exchange rate plummets.
Right.
But because the prices of physical goods haven't had time to rise yet to absorb that new money, the exchange rate actually depreciates significantly more than is mathematically justified by the underlying inflation. It violently overshoots its true long-run target.
It's a massive financial overreaction because the currency market is bearing the entire burden of the adjustment, while the goods market is asleep.
Exactly. But then the timeline shifts. Over the next year or two, the excess money supply finally works its way into the real economy. The restaurant reprints its menus, wages adjust, inflation slowly materializes.
And as those physical prices slowly rise, the initial panic in the currency market subsides.
Yes, the exchange rate slowly appreciates, drifting steadily back up from its panicked, overshot low point until it finally comes to rest at its new, stable, long-run PPP equilibrium.
Wow.
Dornbush provided the mathematical proof for why exchange rates appear so irrationally volatile and disconnected from reality in the short term, while remaining perfectly anchored to macroeconomic fundamentals in the long term.
That is a phenomenal synthesis. It takes all the chaos of the daily financial news and gives it a logical, predictable architecture. To summarize the massive conceptual journey we've taken today, we started by analyzing why a simple burger costs what it does, discovering that localized, non-tradable labor wages artificially skew our perception of exchange rates through the Balassa-Samuelson effect.
We really covered a lot of ground.
We opened up the sovereign ledger, the balance of payments, and realized that running a trade deficit mandates the selling off of domestic assets to foreigners. We navigated the frustrating, counterintuitive reality of the Mundell-Fleming model, learning that in a globalized world, a government's massive fiscal stimulus can be entirely neutralized by its own exchange rate.
A painful lesson for many politicians.
And finally, we arrived at the cosmic constraints of the impossible trinity, demonstrating how every sovereign nation must inevitably sacrifice one core macroeconomic power to survive the modern era.
It is a breathtakingly complex, deeply interconnected machine. And once you perceive the invisible gears turning beneath the surface, you cannot unsee them. It permanently alters how you interpret political promises and global events.
Definitely.
And before we close this analysis, I want to leave you with a final, somewhat unsettling thought to mull over. Let's return to Sidney Alexander's. Absorption approached the equation, CA equals Y minus A.
Okay, the savings identity.
We established that a current account deficit fundamentally means a country is absorbing or consuming more resources than it produces. It is a structural savings shortfall. Now, consider the undeniable demographic trajectory of the world. Populations across the developed world and increasingly in the developing world are aging rapidly.
True, birth rates are dropping almost everywhere.
Demographically, they are transitioning out of their prime, producing and saving years, and shifting heavily into their retiring and consuming years.
They stop contributing to Y, the income and production side, but their healthcare and consumption needs keep A, the absorption side, incredibly high.
Precisely. So, as this unprecedented demographic earthquake accelerates globally over the next 2 decades, how will it permanently distort the balance of payments of the world's major economies?
Oh, wow.
If an entire nation's population is demographically hardwired to absorb more than it produces, can that country ever realistically escape a structural current account deficit? And if half the globe is running deficits to fund their retirements, who is left to generate the surplus capital required to finance them?
That is a staggering implication. It takes a mathematical accounting identity and turns it into a geopolitical ticking clock. It really highlights how these invisible economic forces are silently scripting the future of the globe right now.
It's something we're all going to have to face.
Thank you for joining us on this deep dive into the hidden machinery of international economics. We encourage you to keep questioning the underlying forces shaping the world around you because, as we've clearly seen today, whether we are talking about trillions in government stimulus or the seemingly simple price of a meal across a border, the surface level never tells the whole story. See you next time.